Yes, hello, this is Dan Betzel, and it is Saturday night, I think around 8 o'clock in the evening on October 17th. And I've wanted for a few days now to reach out to my clients and talk to them a little bit about politics in your portfolio. Believe me, this will not be political. There's lots and lots and lots of things we could say about all of that, but that's not going to be for this forum. But I'm getting a lot of questions like, the election is coming up, and as you can see here in 1 second, um, investors' top concerns is the U.S. political uncertainty ahead of the 2020 election. And, um, I certainly get it, right? There's a lot of stuff going on. Um, the pandemic, the election, the economy, all kinds of things going on. But it's just so interesting that um, we all, it's a human nature, we all say, well, this time it's different. And I hope that I can show you in the next few minutes. I'm going to try to go through this very quickly because I know we're all very busy. But in the next few minutes, you're going to see that it really isn't that different. So, you know, discipline wins every election. I'm not going to talk about Republicans or Democrats or whatever, but what does the upcoming election, what does it mean, or what import does it have for your portfolio? So you might find this very interesting. We're going to go back and do some historical analysis here, and you're going to see that election outcomes like markets are unpredictable and far less important to your investing success than you might think. And hopefully, I'm going to establish that here in a couple seconds. That the wait and see isn't a strategy for success. I got a lot of clients telling me, well, maybe they should go to cash, maybe they should wait until January, till the election's over, till things settle. I'm going to hopefully also talk about that myth. And simple strategies for investing success during election years and beyond. So let's go to the next. So I found this really interesting. Remember back in 2016? Um, wow. The people that try to do forecasts, whether they're talking about forecasts of the market, or in this situation, forecasts of the upcoming election, they often get it wrong. So my purpose in showing this to you isn't to get into the nitty gritty about the last election or this election. It's just to show you how we cannot rely on forecasts, whether they're forecasts about the market or the election, or how the two interact with each other. So I'm going to play you two clips from 2016, and then we'll talk about it really briefly. Here we go.
Markets responding dramatically, as we've been discussing, to the current lead by Donald Trump in the Electoral College count. I want to bring Bloomberg's Joe Weisenthal and Guy Johnson, along with RBC Capital Markets Chief U.S. Market Strategist Jonathan Golub. Jonathan, we were talking a few moments ago before that news came in from Florida, just about the degree to which the market may have priced in a Hillary Clinton victory. Your reaction to what we've seen so far tonight?
Well, I mean, obviously the news is a shock, and all evening, instead of watching, I mean, obviously I'm watching the electoral map, but I'm watching the, what the market is doing. I'm watching the S&P. I'm watching the Mexican peso, and it's telling me what the odds of a Trump victory is. We put out a note today saying if Trump wins over the next couple of days, it's a 10 to 12% market pullback.
Markets responding dramatically, as we've been discussing, to the current lead by Donald Trump in the Electoral College count. I want to bring Bloomberg's Joe Weisenthal and Guy Johnson, along with RBC Capital Markets Chief U.S. Market Strategist Jonathan Golub. Jonathan, we were talking a few moments ago before that news came in from Florida, just about the degree to which the market may have priced in a Hillary Clinton victory. Your reaction to what we've seen so far tonight?
Well, I mean, obviously the news is a shock, and all evening, instead of watching, I mean, obviously I'm watching the electoral map, but I'm watching the, what the market is doing. I'm watching the S&P. I'm watching the Mexican peso, and it's telling me what the odds.
We are closely tracking Wall Street's reaction to Donald Trump winning the White House. Dow Jones futures tanked on election night going into Wednesday morning, but then the Dow closed up 250 points yesterday, and today the Dow surged to a new record high at one point, and right now it is currently up over 200 points. Tracking Wall Street's reaction to Donald Trump winning the White House. Dow Jones futures tanked on election night going into Wednesday morning, but then the Dow closed up 250 points yesterday, and today the Dow surged to a new record high at one point, and right now it is currently up.
Any student of history knows that the newspapers, the Chicago Daily Tribune, even printed the newspaper. They were so sure that Dewey was going to defeat Truman, and We didn't have a President Dewey, so that didn't happen. Well, let's take a second and go
Over 200.
Historically, and let's look at what the market has done during periods of Republican control of the White House and Democratic control of the White House. Look here. 1945 to 53, Harry S. Truman, Democrat. He had 2 economic expansions, 1 recession, and the debt to GDP was at 71%. And we could see his first and second, you can see them there, first and second cumulative return, 35.1%, 128.4.
Points.
Okay, let's look at Dwight Eisenhower. We can look at his 2 economic expansions, 3 recessions, his first term, cumulative return, Republican, 111%. Second term, cumulative return, 43.7%. So, as we go through this, that the market finds a way forward, and it's not possible to predict market return based on who wins an election. Of course, this partial first term, an assassination, and nevertheless 34.7%. 1 economic expansion, zero recessions. That was Kennedy, 61 to 63, a Democrat. He was projecting. Of course, then we have Johnson, another Democrat, the vice president who assumed the presidency. His first term, 65%. Second term, 39%. Negative 12. That's Nixon. Okay, Nixon, first term, 28.7%. Second term, negative 29%. It was actually Ford, of course. Nixon resigned. Ford took over. He was the vice president. So interesting, right? I think he was the only president who was never elected because I think he was appointed when the vice president had to resign, and then he became president. His first term really up, and then we go to Jimmy Carter. Everyone talks about how difficult, how bad things were during the Carter years. Well, I don't know. Let's look. His first term, 55 point. Well, not his first term, but his only term. Okay, Ronald Reagan. Let's look at his 2 terms. 50% first term and 98.2%. I think by the end of the day, George Bush the first, 72.7%, 2.5%, and Bill Clinton, his first term, 98.8%. 83%. Do you see the pattern here? I'm going to put it all together for you in a second. You can see what's happening as the market finds a way forward, no matter who the president, and continue to go up from George W. Bush. Okay, this was a tough time, right? First term, -6. Second term, -25. So he was go to Obama. His first term is 44.8 and 66.4, off by about 4. Then we have the current, the president, cumulative return for the first up to the last data is 51.5%. So, yeah, this is what we're facing in front of us, right? I mean, one of these 2 people, one of them is going to be the next president of the United States, and although this picture for everyone, depending on what side you're on, could be frightening if the person that you hope wins doesn't. 14% or so. Everyone forgets that. But this isn't the first time that these prognosticators have rewarded long-term investors regardless of president or political party. So you look here, right? You see from Coolidge all the way to Trump. I was showing this to a friend of mine. He was a little cocky. He's not like me. He said, "Oh yeah, I really can't figure out the trend here in this photo." He was trying to be funny, but you can see the trend, right? No matter what, if you look at the long-term market, no matter if it was Roosevelt, Truman, Eisenhower, Kennedy, Johnson, Nixon, Ford, Carter, Reagan, Bush, Clinton, Bush number 2, Obama, or Trump, you can see what the market has done. Now, some people say, well, okay, I'm not so worried about who's in the White House. I'm more concerned about who controls Congress. Well, this is the breakdown of which party controlled Congress. The Republican, red, the Democrat, it's like a kind of off blue, and then when you see the striped, it's when it was mixed, when one party controlled the House, one party controlled the Senate. Nevertheless, you can see it doesn't matter, right? It might matter in the short term. There might be policies that you like or don't like. There might be tax consequences that impact certain people. I'm not trying to say that it doesn't matter who controls the White House or who controls the Congress. It does matter. It just doesn't matter for your portfolio. That's the point I want to make, right? For all kinds of other issues, it's extremely important. But our market, our economy, always finds a way forward, regardless of who's in the White House and which party controls either or both houses of Congress. So election outcomes, like markets, are unpredictable and are far less important to your investing success than you might think. And the wait and see, it just isn't a strategy for success. Let's look at some simple strategies for investing success during election years and, of course, beyond. So, I'm just going to wait and see how the election plays out before I do anything. And doesn't volatility spike during elections? That's a really interesting question that I, intuitively I thought, well, yeah, I think that probably does. But when I actually looked at the research, I was surprised on an emotional level, but not on a cognitive or intellectual level. I'll show that here in a second. Look at this. So 100 days before the presidential election, the S&P volatility index 13.8%, and 100 days after, the exact same thing. I mean, that's from January 1st, 64 through December 31st, 2019. Absolutely fascinating, right? So it doesn't spike right before, right? 100 days before, 100 days after. So this is interesting. Americans are hoarding trillions of dollars in cash before the presidential election, Morgan Stanley says. And this is typically what happens. If you're familiar with the Dalbar report, I've talked about that in the past. You can see this chart here, year 1, 2, 3, and year 4 of a presidential election. What's it showing is the average net fund flows by years of a presidential term. In the first year, the blue box on the left-hand side, you see money pouring into equity funds and coming out of money markets. Next year, you can see what happens, and then the third year, you can see the money market funds are actually growing. And in election year, what do people do? They move out of equities and into cash. And is this a good idea? Well, let's look and see. So let's look at a hypothetical $10,000 investment strategies during an election cycle. Let's say you stay fully invested. And let's say that you're putting money in on a consistent contribution, like into your 401k or monthly contribution to your Roth, or you just sit on the sidelines and you wait until January 1st after the election, things have settled, right? Well, if you just were sitting on the sidelines, your $10,000 would grow after 22 election cycles, beginning in 1932, to $14,914. If you had just kept up with your consistent monthly contributions during that period, you would actually have $15,729. And if you just had stayed invested, that would have been the best. Your $10,000 would have grown to $15,866. So, election outcomes, like markets, are unpredictable, and they're far less important to your investing success than you might think. The wait and see isn't a strategy for success, and simple strategies for investing success during election years and beyond are going to tell us what? Don't try to predict future market outcomes based on current news. I know I did it very quickly, but we went back and looked at who controlled the White House, Republicans and Democrats, and you cannot tell what the market's going to do, except that the trend is always long-term up. We also looked at the slide, if you remember, between showing which party controlled the House, which party controlled the Senate. Did the same party control both, or was it mixed? And we saw the market, the trend is always up. So, don't mix political party preference with the success of your portfolio. And behind that rule number 2, you can see a little bit like in a ghost shaded out, this upward trend of the market, no matter which political party has control of the White House. So what's really important, more so than who occupies the White House, more so than who controls Congress, it's actually your behavior. Your behavior is more likely to affect your retirement than any election will. So, investment return versus investor return. Why is it that, I just had someone say to me, well, why is it the S&P 500 has been up almost 10% in the last 10 years, but I didn't get 10%? Well, there's a couple reasons. You didn't stay invested the whole time. You kept moving your investments around. And the average investor, about every 3 to 3.5 years, they change their investment philosophy. And this creates this behavior gap between the actual investment return and the investor return. So who's going to win the election? I don't know. The one thing I do know, discipline as far as your portfolio is concerned will win every election. So I know it's a stressful time right now. There's a lot for us to be concerned about, to be stressed about. But I hope that one thing will not be your portfolio, because evidence shows that you should vote for your candidate with the confidence that your portfolio doesn't care who wins. Now, I'm not saying it's not very important. Please don't take this the wrong way. I'm saying for your investment future, your portfolio doesn't care. Now, in the short term, can we expect some market volatility? Yeah, of course. But in the long term, remember, have that chart, emblazed in your memory, in your mind, that the trend is up. So, thank you so much. I know we're just a few weeks away from the election. I think we'll, I know we'll make it. I know we will. And I wish everyone a wonderful week. And I did go vote last week. I've never voted early before. I went to the Franklin County Board of Elections, and it was a long, long line, but it moved very quickly. I was there about 50 minutes, and I felt so good that I was able to get that done. So whether you're voting in person in November or early, or you're doing it by mail, please vote, and I'll look forward to talking to you soon. Thank you.
Of a Trump victory is we put out a note today saying if Trump wins over the next couple of days, it's a 10 to 12% market pullback.
Okay, did you catch what he said? They put out a memo earlier today that if Trump wins, it is a 12% market pullback. Now, I remember that night very clearly. I remember what happened in the overnight trading. I remember that there was 700 or 800 point loss in the S&P. But by the next morning, it had turned around. Now, the purpose of this, again, is that people that are supposedly should know, that are very smart, they're trying to predict the market in relationship to the what's going on in the political arena, and they can't do it. Here's the next